Your financial advisor is charging you $590,000 and doing 4 hours of work. No cap. Your financial advisor charges 1% of your assets per year. Just 1%, they said. Barely anything, they said. On a $500,000 portfolio, that's $5,000 a year. Over 30 years, with compounding factored in, that 1% fee costs you $590,000. $590,000. Gone. Not because the market crashed, not because of bad luck, because of a fee you nodded at in a conference room while pretending you understood what was happening. And here's the part that's going to make you put your phone down for a second. Most of what a financial advisor does, you can do yourself in 4 hours a year. The wealthy already figured this out. The question is whether you're going to catch up now or keep paying someone else to do something you are fully capable of doing. I'm Raj, and in this channel I explains how money actually works in America. No jargon, no sales pitch, no hidden agenda. If you're someone who feels like the financial system was designed for people who already have money, hit subscribe and drop a comment. I want to know where you're starting from. Here's the current situation, and it is sending me. According to a 2024 Gallup survey, only 36% of Americans work with a financial advisor. The other 64% are either winging it completely or doing absolutely nothing. And both groups are losing money, just in different ways. Dalbar's annual quantitative analysis of investor behavior. Yes, that's a real report. Yes, it slaps. Shows that the average self-directed investor underperforms the S&P 500 by 3 to 4 percentage points every single year. Not because they're doing anything crazy, because they panic. They sell when it drops. They buy when it's already up. They let their emotions run the portfolio like it's a group chat. So here's the situation. You pay an advisor and bleed fees for 30 years. Or you go it alone with zero framework and make decisions based on vibes. Both paths cost you serious money. But here's what the data also shows. A specific subset of self-directed investors consistently matches or beats advisor-managed returns. And according to Vanguard's own research, the behavioral coaching and advisor provides adds about 1.5% in annual returns, but only if you don't already have a system and the discipline to follow it. If you have a system, you don't need to pay for the system. That's the whole video. I'll show you what that system actually looks like, and it's not what most financial content is out here telling you. Chapter 2. The 3-account setup. This is the main quest. Okay, here's where we build the actual system. And I need you to understand this is not complicated. It is just disciplined. There's a difference. Wealthy Americans don't have some secret investment no one's heard of. They have a 3-account structure and they follow an order of operations. That's it. Here it is. Account 1. Your 401k, funded at least to the employer match. According to Fidelity's 2024 retirement report, 22% of Americans leave employer match money on the table every year. If your employer matches 4% and you're only contributing 2%, you just voluntarily took a 2% pay cut. No one is making you do this. You are doing this to yourself. The employer match is a 100% instant return on your money. There is no investment, no stock, no crypto play on earth that gives you that guaranteed. Fund it first, period. Account 2. A Roth IRA, funded to the $7,000 annual limit if you're under 50. The Roth is the most slept-on wealth tool in America, and it drives me insane. You contribute money you've already paid taxes on. It grows tax-free. You pull it out in retirement and pay zero taxes on any of it. Zero. On a $500,000 account, that's potentially $100,000 or more in taxes you never hand over to the government. It's completely legal. It's been sitting there this whole time. Use it. Account 3. After those two are funded, everything else goes into a taxable brokerage account at Fidelity, Vanguard, or Schwab. You buy a total market index fund or an S&P 500 fund with an expense ratio under 0.05%. You set automatic contributions. You do not touch it. You do not log in every day. You do not make decisions based on what a finance influencer posted at 2 a.m. And here's the kicker. Once this system is set up, it takes 30 minutes a year to manage. 30 minutes. A financial advisor charges $1,500 to $3,000 to build you this exact setup. You just got it in 2 minutes for free. You're welcome, genuinely. Chapter 3. The Behavior Gap. The Final Boss. Nobody warned you about. Here's the thing that actually destroys people's wealth, and it has nothing to do with picking the wrong stock. Vanguard calls it the behavior gap. I call it your brain betraying you at the worst possible moment. March 2020. The S&P 500 drops 34% in a few weeks. Absolutely cooked. Looks like the end. In the 6 weeks following that drop, retail investors pulled $326 billion out of equity funds, according to the Investment Company Institute. $326 billion of panic selling. By August of the same year, the market had fully recovered and hit new highs. The people who sold locked in real permanent losses. The people who did nothing, who just let the chaos unfold without logging into their account, made money.
Doing nothing was the correct financial move. That sentence should not be controversial, but here we are. Here's why this happens, and it's not a character flaw. Your brain processes financial loss the same way it processes physical danger. Losing $20,000 on paper activates the same stress response as a genuine threat. Your body is telling you to run. The market is a bad group chat getting leaked, and your instinct is to leave immediately. The problem is, leaving is the thing that costs you. The solution is not to be tougher or more zen. The solution is to remove the moment of decision entirely. You set automatic contributions that go out on the 1st of every month directly into your index fund, no matter what the market is doing. When prices drop, you automatically buy more shares at a discount. This is dollar cost averaging, and it mechanically forces you to do what every investor knows they should do, but emotionally can't pull off. Let me show you the math on this. Two investors. Both start with $10,000 in January 2020 and contribute $500 a month. Investor A panics in March and pulls out. Investor B does absolutely nothing. By December 2021, Investor A has $87,000. Investor B has $131,000. One decision, one moment of, I can't watch this anymore, costs $44,000. Automate, disappear, come back in a year. That's the move. Chapter 4. When you actually need an advisor, be honest with yourself. Okay, I have to be fair here because I'm not saying advisors are a scam. I'm saying most people don't need one yet and are paying for one anyway. Here's the honest breakdown. You do not need a financial advisor if you are under 50. Your financial situation is relatively straightforward. You don't have a pension with complex options, you don't have a business with equity compensation, and you don't have a multi-million-dollar estate to protect. That describes most people watching this right now. What you actually need is a one-time fee-only financial planner, not someone who earns commissions every time they move your money into a different fund. Someone you pay a flat fee, typically $200 to $500, for a single session to review your specific situation, confirm your allocation is right, and answer your actual questions. You use them like a doctor, not a gym membership you pay for out of guilt every month. The National Association of Personal Financial Advisors, NAPFA, has a directory of fee-only fiduciary advisors. A fiduciary is legally required to act in your interest, not their own. Most commission-based advisors are not fiduciaries. That one distinction is costing Americans billions of dollars a year, and almost nobody talks about it. Now, you might be thinking, but what about when the market crashes and I need someone to talk me off the ledge? Look, in a genuine crash, the guidance from every credible financial source is identical. Do nothing. Stay invested. Rebalance once a year back to your target allocation. You do not need to pay $3,000 a year for someone to tell you to do nothing. You need to build the conviction yourself before the crash happens, so you already know your move. And conviction comes from understanding the history. Every single market crash in American history, every one has been followed by recovery. Every time, selling in a crash is not playing it safe. It's locking in a permanent loss on a temporary problem. Main character energy is staying in while everyone else panics. Chapter 5. The one thing to do before any of this, don't skip. Before you open a single account, do this. Run a net worth audit, not a budget, not a savings challenge. A net worth statement. Write down every asset you own, savings accounts, retirement accounts, any investments, and their current values. Then write down every liability credit card balances, student loans, car loans, mortgage. Subtract liabilities from assets. That number is your current net worth. It is your financial scoreboard, and you cannot win a game you're not tracking. According to the Federal Reserve's 2023 Survey of Consumer Finances, the median net worth for Americans aged 35 to 44 is $135,300. Now you know the benchmark. Now you know if you're behind, ahead, or right in the middle. Either way, you can't navigate without knowing where you're starting. Do this tonight, 20 minutes. Use Personal Capital or Empower, both free. Both connect your accounts automatically. Both give you a dashboard that actually makes this feel manageable instead of terrifying. Once you have the number, every financial decision gets filtered through one question. Does this move increase my net worth or decrease it? That question alone rewires how you spend, save, and invest. One question before you go: what is your current net worth, and do you know the number off the top of your head? Drop it in the comments. No judgment, no comparison, just accountability. Let's see where everyone's at. If you want to understand how to structure your income to legally minimize on top of all of this, so you keep more of what you actually make, watch the next video. I break down the exact strategies which will make you financially stable forever. It's not complicated, it's just not talked about enough.